there is a number that almost nobody is watching right now. And by the time it makes headlines, the opportunity that comes with understanding it today will already be gone. Right now, as you watch this, the physical silver market is quietly running dry. Even as the paper price on your screen barely moves, that gap between what is happening in vaults and mines around the world and what is showing up on your trading app is the single most important story in commodities markets that almost nobody outside a small circle of analysts is talking about. Stick with me for the next few minutes, because by the end of this video, you will understand exactly why that gap exists, why it has persisted for so long, and why the economic forces now converging on the silver market make this moment fundamentally different from anything we have seen in more than a decade. Before we go further, I want to know something about you. Comment below and tell me where you're watching from and whether you currently hold gold, silver, or cash as your safe haven. I read these and it genuinely helps me understand who this channel is reaching and what matters to you. Let's start with the foundation, because you cannot understand what is happening in silver today without understanding the machinery of money itself. Every modern economy runs on a delicate balancing act managed by central banks, and in the United States that responsibility falls to the Federal Reserve. The Fed has two official jobs: keep prices stable and keep employment high. In practice, those two goals are almost always in tension. When the economy overheats and inflation rises, the textbook response is to raise interest rates, making borrowing more expensive, cooling demand, and bringing prices back under control. When the economy slows and unemployment rises, the opposite happens. Rates come down, credit becomes cheap, and money flows more freely through the system. This sounds simple in theory. In practice, it is one of the most consequential balancing acts in the modern world, because every adjustment in interest rates ripples through bond markets, currency markets, and ultimately the price of every asset you own. Here's the part most people never stop to think about. Interest rates are in effect the price of money itself. When rates are low, money is cheap. And cheap money tends to flow toward assets, stocks, real estate, and yes, precious metals. When rates rise, money becomes more expensive, and that flow can reverse, at least for a while. But there's a deeper layer beneath this. Governments today, including the United States, carry debt loads that are historically unprecedented in peacetime. When debt is this large, higher interest rates don't just cool the economy, they dramatically increase the cost of servicing that debt. This creates what economists call fiscal dominance, a situation where monetary policy decisions start being shaped not purely by inflation targets, but by the government's own need to keep interest payments manageable. This is not a conspiracy theory. It is a well-dominant dynamic that shows up again and again throughout financial history, from post-war Britain to Japan's decades-long battle with debt. When a government owes more than it can comfortably pay at high rates, the pressure to keep rates lower than inflation would otherwise justify becomes almost irresistible. And when interest rates are held below the actual rate of inflation, something important happens. Money loses purchasing power even while sitting safely in a bank account. Economists call this financial repression, and it has a long, well-documented history as a tool governments use to quietly manage down the real value of their debts. This is where gold and silver re-enter the story, because for over 5,000 years in every culture, in every era, humans have returned to precious metals as a store of value precisely during periods when currencies are being debased. Gold in particular has functioned as a form of monetary insurance, an asset that central banks themselves hold on their balance sheets alongside government, bonds, and foreign currency reserves. And here is a fact that deserves far more attention than it currently receives. Central banks around the world, particularly in emerging economies like China, India, Turkey, and Poland, have been accumulating gold at a pace not seen in decades. According to data from the World Gold Council, central bank gold purchases exceeded 1,000 tons annually in recent years, a dramatic acceleration from the pace seen throughout most of the 2010 seconds. This is not idle accumulation. Central banks are professional, methodical institutions, and when they collectively shift strategy on this scale, it reflects a broader recalibration of how nations think about currency risk, reserve diversification, and protection against a world where trust in any single currency, including the US dollar, can no longer be taken for granted. Silver sits in a fascinating and often misunderstood position relative to gold. Unlike gold, which is held almost exclusively as a monetary and investment asset, silver lives a double life. Roughly half of global silver demand comes from industrial use. Solar panels, electronics, electric vehicles, and medical technology all depend on silver's unique properties as the most electrically conductive metal on Earth. The other half of demand comes from investment and monetary use. coins, bars, and silver-backed financial products. This dual identity makes silver's price behavior fundamentally different from gold's. When industrial demand surges, as it has with the global expansion of solar energy infrastructure, that demand adds directly to the pressure already coming from investment buyers. And unlike gold, which has enormous above-ground stockpiles built up over centuries, a significant portion of silver that gets used industrially is consumed and not economically recoverable, meaning the available above-ground supply is thinner than most people assume. Let's talk about the psychology of markets for a moment, because understanding human behavior is just as important as understanding economic data if you want to make sound long-term decisions. Our brains did not evolve from modern financial markets. They evolved for survival on the savannah, where the biggest threats were immediate: a predator, a rival tribe, a natural disaster. That wiring still governs how we process financial risk today. When markets are calm and prices are stable, our brains release a slow, steady stream of dopamine tied to routine and predictability. And this is precisely when most people feel safest, putting money into an asset, right? When risk is often quietly building beneath the surface. But when fear enters the picture, an entirely different system takes over. The amygdala, the brain's threat detection center, floods the body with cortisol and adrenaline, triggering the same fight or flight response our ancestors used to escape predators. In financial terms, this shows up as panic selling at market bottoms and euphoric buying at market tops, the exact opposite of what a rational, unemotional strategy would suggest. This is why the most successful long-term investors are not necessarily the smartest people in the room. They are often simply the ones who have trained themselves to recognize these biological impulses and act deliberately against them. Let me tell you about someone who learned this lesson the hard way. Picture a man named Richard, 58 years old, a retired mechanical engineer who spent 30 years designing industrial equipment before retiring with a modest pension and a healthy stock portfolio. In 2008, as the financial crisis unfolded, his portfolio dropped to nearly 40% in a matter of months. Richard did what millions of investors did. He panicked. He sold nearly everything near the bottom, converting his portfolio to cash to, in his words, stop the bleeding. The market recovered within 18 months, but Richard had locked in his losses and missed almost the entire rebound. It took him nearly a decade to rebuild what he had lost. Richard's story is a fictional composite, but it reflects a pattern documented repeatedly by behavioral finance researchers. Investors who sell in a panic during downturns systematically underperform those who simply hold steady, not because they lack intelligence, but because fear overrides rational judgment at exactly the wrong moment. Now contrast that with someone like Elena, a 43-year-old small business owner from Toronto who began allocating a modest, consistent percentage of her savings into physical silver and silver mining stocks, starting in the early 2020s, not as a speculative bet, but as a long-term hedge against currency debasement she had read about and understood. Elena's approach was unglamorous. She didn't try to time the market. She simply said a fixed percentage of her monthly savings toward physical bullion and a diversified basket of mining companies, treating it the way one might treat an insurance premium, a steady cost paid for protection against a risk that might not materialize for years, but which, if it did materialize, would matter enormously. This is a fictional illustration, but it reflects a well-established investment principle. Dollar cost averaging into an asset class over time reduces the emotional burden of trying to guess short-term price movements, and it is a strategy used by disciplined investors across every asset class, not just precious metals. Now let's return to the mechanics of the silver market itself, because this is where the story becomes genuinely fascinating. Silver, unlike almost any other commodity, trades primarily through paper markets, futures contracts on exchanges like COMEX in New York that are many multiples larger than the actual physical silver available for delivery. This is not unique to silver. Many commodities trade with paper markets larger than physical supply because futures markets exist primarily for hedging and price discovery, not physical delivery. But some analysts have long argued that in silver's case, the sheer scale of paper trading relative to physical stockpiles creates a structural disconnect where the price discovered on the futures exchange does not accurately reflect the tightness of physical deliverable metal. This is the essence of what people mean when they talk about silver price suppression. The argument that concentrated short positions by a small number of large financial institutions have at various points weighed down the price relative to what physical supply and demand fundamentals would otherwise justify. It's important to be clear here. This is a contested claim. Regulators, including the CFTC, have investigated silver market positioning multiple times over the past 2 decades and have not found conclusive evidence of illegal manipulation. At the same time, the underlying observation that paper silver trading volume vastly exceeds physical silver available for delivery is not in dispute. It is a documented structural feature of the market. Reasonable analysts disagree about what that structural feature actually means for where prices should be. What is not in dispute is this. Physical silver inventories held in registered COMEX vaults and in major exchange-rated funds have shown a declining trend over recent years. Even as industrial demand for silver and solar panel manufacturing has grown dramatically, the Silver Institute has documented consecutive years of what is called a structural market deficit, meaning global silver demand has outpaced global mine supply and recycling combined. When any market runs a sustained deficit, someone somewhere is drawing down existing stockpiles to meet the shortfall. Stockpiles are not infinite. And when the visible, easily accessible portion of those stockpiles becomes depleted, price becomes an increasingly urgent mechanism for rationing scarce supply. Whether that adjustment happens gradually or abruptly, this is where currency dynamics add another crucial layer to the story. The US dollar has functioned as the world's primary reserve currency since the Bretton Woods Agreement in 1944. And that status has given the United States what French officials once called an exorbitant privilege, the ability to run trade deficits and borrow in its own currency more easily than almost any other nation on earth. But that privilege is not permanent and it is not unconditional. It depends on the world's continued confidence that the dollar will hold its value and that U.S. institutions will remain stable and predictable. When that confidence wavers even slightly, the ripple effects show up first in currency markets, then in bond markets, and eventually in the price of alternative stores of value like gold and silver. We have seen glimpses of this dynamic play out over the past several years as geopolitical tensions, sanctions regimes, and the weaponization of currency reserves following events like the Russia-Ukraine conflict have prompted a number of nations to actively reduce their reliance on dollar-denominated reserves. This is not a prediction of dollar collapse. The dollar remains by a wide margin the dominant global reserve currency, and it is likely to remain so for the foreseeable future. But the direction of the trend, gradual incremental diversification away from dollar concentration, is a real and measurable phenomenon, not speculation. Now, before we go further into how all of this connects, I want to ask you to do 2 quick things. If you're finding this breakdown valuable, take a moment to like this video. And if you haven't already, subscribe to the channel because I cover these macroeconomic threads regularly, and I promise you the final insight we're building toward in the next few minutes ties every piece we've discussed so far into a single coherent picture. Stay with me until the end because it will genuinely change how you look at the headlines you read tomorrow. Let's talk about historical parallels because markets rarely do something entirely new. They tend to rhyme with the past. In the late 1970s, the United States faced a combination of high inflation, a weakening dollar, and eroding confidence in the Federal Reserve's ability to control prices. Over that decade, gold rose from around $35 an ounce to over $800 an ounce at its peak in January 1980, and silver rose even more dramatically in percentage terms, driven by a combination of genuine monetary anxiety and notoriously attempt by the Hunt brothers to corner the physical silver market, which ended in a spectacular crash once regulators intervened. That episode is often cited by skeptics as proof that speculative excess, not monetary fundamentals, drive silver's biggest moves, and that's a fair point worth holding on to. But the broader 170 seconds environment, stagflation, negative real interest rates, and a crisis of confidence in fiat currency management is worth studying closely today. Not because history repeats exactly, but because the underlying economic pressures of that era, high government debt, persistent inflation concerns, and currency policy under strain echo, at least in part, conditions we're observing today. I want to be careful here. No serious analyst can tell you with certainty that today's environment will produce the same outcome as the end. Economies are far more complex than simple historical analogies suggest, and countless variables from technological change to global trade structures differ enormously between then and now. What we can say with more confidence is that the toolkit central banks have historically reached for during periods of high debt and persistent inflation. Keeping real interest rates low has tended to be supportive of precious metals prices over multi-year periods because lower negative real rates reduce the opportunity cost of holding a non-yielding asset like gold or silver. Let me introduce you to one more investor because I think his story illustrates something important about patience and discipline. Consider a man named Marcus, 31 years old, working as a data analyst in Austin, Texas, who began researching precious metals after watching his parents struggle through the 2008 financial crisis as young homeowners. Marcus decided early in his career that he wanted a portion of his savings insulated from what he saw as long-term risk in fiat currency policy. Rather than putting his entire savings into silver, which would have been a concentrated and risky bet, Marcus allocated roughly 10% of his long-term portfolio to a combination of physical silver mining equities and broader precious metals exposure, while keeping the majority of his savings in a diversified mix of stocks, bonds, and cash reserves. Over the following years, his precious metals allocation experienced periods of frustrating stagnation, months where the price barely moved despite what he believed were supportive fundamentals. This is a fictional composite, but it reflects a real and important lesson. Even assets with genuinely strong long-term fundamentals can move sideways or even decline for extended periods. And investors who cannot tolerate that uncertainty often abandon a position right before it eventually performs as expected. Patience in financial markets is not a passive virtue. It is an active discipline that requires ongoing emotional regulation precisely because our brains are wired to demand immediate feedback and validation for our decisions. This brings us to the mining companies themselves, which deserve their own careful explanation, because silver mining stocks behave very differently from physical silver. Silver mining companies are, in economic terms, leverage plays on the price of silver. If it costs a mining company roughly $18 to extract an ounce of silver from the ground, and silver is trading at $20, that company's profit margin is a modest $2 per ounce. But if the silver price rises to $25, that same company's margin has more than tripled from $2 to $7 per ounce, even though the underlying commodity price only rose by 25%. This operating leverage is why mining stocks tend to be significantly more volatile than the metal itself, rising faster during bull markets and falling harder during downturns. This is not a flaw in the mining sector. It is simply the mathematical reality of fixed cost extraction businesses operating against a variable commodity price. For investors who understand and accept this volatility, mining equities can offer amplified exposure to a thesis on rising silver prices. But for investors who cannot tolerate sharp drawdowns, physical silver or diversified metals funds may represent a more appropriate vehicle for the same underlying view. Now, let's bring together the geopolitical dimension, because no discussion of monetary metals in this era would be complete without addressing the fracturing of the post-Cold War global economic order. For roughly 3 decades following the collapse of the Soviet Union, the world operated under a relatively stable framework of globalized trade, dollar dominance, and broad geopolitical cooperation. Even amid regional conflicts, that framework has been visibly straining in recent years. Trade tensions between the United States and China, sanctions regimes imposed on Russia following the invasion of Ukraine, and a broader trend toward what economists call delgization, nations prioritizing supply chain security and strategic autonomy over pure economic efficiency, have all contributed to a more fragmented, less predictable global economic environment. In this kind of environment, historically, investors and institutions alike tend to place greater value on assets that do not depend on any single government's promise, any single currency stability, or any single counterparty solvency. Gold and silver, precisely because they are physical, tangible, and universal,